Hey everyone, I'm Jack. I'm a quantitative developer here at QuantConnect, and I'm here this week to bring you guys Idea Streams, which is a weekly video series where we take a look at current market trends and events and try and turn it into a trading strategy on the QuantConnect platform. So today we're going to talk about tail risk hedging, and this comes from a recent Twitter debate between Nassim Taleb and from Cliff Asness, one of the founders of AQR Capital. And what they discuss is different approaches to the benefits of tail risk hedging. So tail risk events are broadly defined as extreme market events. So we're talking about, in terms of equities, the recent market crash, the 2008 financial crisis. You can think of the dot-com bubble too. And so what Taleb argues is that hedging, or using a hedge to account for these tail risk events, is good, it's beneficial, it's worth it. He's arguing that you should incorporate these into your portfolio, or maybe not necessarily that you should, but that these hedges do pay off in extreme times and therefore have value. And he criticizes AQR by saying that they're either not doing enough or they're not doing the right kind of tail risk hedging. But AQR Capital's point is that they're looking at a longer term investment horizon. So tail risk hedging usually is costly when markets are good because it's built to pay off when markets are bad. And so AQR's point is that when you look at the long run, it's such a drag on your portfolio that oftentimes it's actually not worth to have the tail risk hedge, and instead to ride out a crisis condition because your overall returns over the longer period are going to be higher. And so what we're going to do today is we're going to take a look at one tail risk hedging strategy. So we're going to buy out of the money put options, and we're going to use those to balance out a portfolio of the S&P 500 ETF, SPY. And what we're going to do is we're going to start with a 1% capital allocation to far out of the money put options, and 99% of our portfolio is going to be SPY. And what we're going to do is we're going to look for put options that are about 1 year time to expiration. And there's a lot of ways to approach tail risk hedging, using derivatives other than puts, using asset diversification, all sorts of other methods. But today what we're going to do is we're going to take 1 year contracts, hold those, and then roll them over into a new 1 year contract once they hit 6 months time to expiration. Again, this is just one way to do it. This is going to be our approach today. And we're going to see what the cost benefit is between having that tail risk hedge in your portfolio versus not having it, and see if we can't try and understand what the point is behind the Twitter debate, or understand each side's point. So what we're going to do here first is I'm going to open up a new algorithm here. So we're going to go into the QuantConnect terminal. That's going to load up. I'm going to just create a new algorithm. And here we go. So we want to backtest a longer strategy. Like I said, the point from AQR is that on a long-term scale, hedging often costs more than it's worth. So we're going to look at a portfolio that is actually held from the 1st of January 2007 all the way till the present. So this is going to give us a good long-term picture, and it actually is going to cover two market crises or tail risk events, which are going to be the recent crash and then the 2008 financial crisis. So we're going to add SPY, as that's the majority part of our portfolio. And since we're going to be trading options, we actually need to set the data normalization on SPY to use raw data, as using options requires that the underlying data is raw as opposed to adjusted, which is the default here. So I'm setting that, oops, sorry about that. I'm setting that, and then I'm actually going to create this variable here to store the SPY symbol for later use. Using symbols is much better than using tickers. It's more reliable. It's better to use when you're on the QuantConnect platform. And then I'm going to create this variable called contract. And what this is going to do is it's going to store the current contract that we're trading or that we have in our portfolio, and then we reassign it when we decide to roll it over. So it's going to be helpful for us later on. All right, so the first step is to figure out if we are invested or not in SPY. And so we're going to check that. And if we're not invested, and this will just really be at the start because we're buying and holding our portfolio of SPY, is we're going to check to see if that's invested. And if it's not, we're going to use the set holdings method here. And we're going to use the SPY symbol, and we're going to allocate 99% of our portfolio to SPY. And now there's no consensus best allocation. There are a few different opinions on it. You know, there's some places that say between 0.5 and 1%, you might allocate more, depending on how much of your equity investment you want to cover with these options. So for our purposes, 1%, but that's an open debate. All right, so we have our portfolio of SPY now. And so what we need to do is figure out how we're going to get our contract. So usually with options, if you want a big set of option chains that cover a variety of strike prices and time to expirations, and you want a lot of options data, you would set the filter somewhere up in here in the initialize method, and you'd get a lot of data back. But for us, we know pretty much exactly what kind of option we want. We want put options that are about 40% out of the money. Again, you can look at different out of the moneyness, 40, 30, 20%. We're going to stick with 40, and we want the duration or time to expiration to be about a year or as close as we can get to that. So since we have a narrower scope of the options data we want, we're going to use the option chain provider. And I'm going to go into the documentation here. We're going to skip down to the options section just to reacquaint ourselves. And we have the option chain provider method here. And so what it does is you pass it the symbol that you want to use and the date or the time that you want to access the contracts at. And it's going to return a list of the contracts that are available at the time. And this is how we're going to narrow down the scope. So we're going to get that list, we're going to filter it, and then we're going to add the one contract that we want. And so we're really reducing the amount of data and speeding up the backtest. So we'll go back here. And the way we want to do this is we need to check to see if our contract has been assigned yet. So we're going to check to see if it is none, which we set it to start at none. And if it's none, we're going to reassign it. And we're going to use a custom function that we will call, let's just say, get contract. So in this function, we are going to use, like I said, the option chain provider, but we need to understand what the target strike price we want is. So again, 40% out of the money. So what we're going to do is we're going to call a variable here. We're going to define a variable here. And we're going to make sure that it is about 40% out of the money. But the strike prices are usually in increments of 5 for SPY. And so 40% of the current price of SPY that we access here in the securities might not be an even increment of 5. So what we're going to do is we're going to use a little trick here. And this is going to give us the closest increment of 5 to our 40% out of the money strike price. And then after this, we have our strike. So what we need to do is we need to get our contracts. So we're going to use the option chain provider. As I mentioned, this is going to take a time argument and a symbol argument, and it's going to return the option contract list right here. So we're going to pass it our SPY symbol, and we're going to give it the current time. And so this is going to be a list of contracts. And then what we need to do is start filtering them. So we only want puts, so that's our first filter here. And so we're going to take all of the contracts that are puts. And in this list comprehension, X is actually a contract symbol, but the security identifier, so the .id property here, has the strike price and the expiration date. So that's how we're going to use that. And it also has the option right. So we're going to check to see if that is a put. And if so, we're going to keep it. If not, we're going to discard it. And then we now want to sort them, the puts that we have based on the time to expiration and the strike price. So we want the longest expiration, but the smallest strike price, because we've set our target to about 40% out of the money. And we're going to filter that later to try and find that exact strike price. But for now, we're just going to filter it like this. So first we'll sort the puts, and we'll sort it based on the time to expiration. So the security identifier .date is the time to expiration. And we're going to sort that in reverse so that it's a descending order. So our longest time to expiration is first on the list. And then what we actually want to do now is sort this list as well. So we're going to sort that list that we just created. And we're going to use a function that sorts it by the strike price. Okay, I think that's right. So next, we want to find the put contracts or the put options that have the same strike price as our target. So what we're going to do is we're going to check for that as well. So it's another filter that we're applying here. Inputs if x.id.strike price. And we're checking to see that it's the same as our target strike. And then lastly, we want to filter based on the time to expiration. So the same strike price, or any individual strike price, is going to have a number of contracts with different times to expiration. And so we want to find something that's close to a year. And early on in SPY, there's not necessarily contracts that are going to be exactly a year. It's not quite as liquid, but we're going to do the best we can. So we're going to put in a range, let's say, of 270 to 420 days. We'll just go with that for now. And what we're doing here is we're checking for the difference between the time to expiration and the current time. And we're taking the number of days and filtering based on that. So we have our puts here. And if we don't get any puts, then we don't want to hedge. We don't want to hedge with a suboptimal put option or one that we don't actually want to use. So we're going to restrict ourselves to either being hedged or not at all. And this should be an infrequent condition, but it's a good one to just check, make sure that we have. So if we have no puts, then we're going to return none. Otherwise, we're going to use the add option contract method here. Oops, puts 0. And to find the resolution. And now this will add the specific contract we selected to the data feed. So again, we're avoiding the issue of having this massive amount of data because we've set a huge filter, and instead we're finding the exact contract we want, and then we're going to be able to trade that one without slowing ourselves down too much. And since we're assigning the contract up here, what we want to do is actually return this as well. So we're going to return the put option. And this way we can keep track of this contract later on, and we can figure out how we want to trade it, when we want to roll it over. And this is just going to be helpful. So if contract is none, assign the contract. Good. Now, we also want to make sure we're checking to see when we need to roll it over. So we're going to add in a condition to see if the contract time to expiration difference, or the difference between the expiration date and the current algorithm time in days, is less than 180. What this means is that our contract is now within 6 months time to expiration, and so we want to roll it into that new one. And what we need to do is we need to make sure we liquidate our old position. And then we're going to remove security and pass it the contract. And what this does is it just drops the contract from our universe. So we're no longer tracking it. We don't need it in our data feed anymore. So it's irrelevant. So we might as well get rid of it. It makes things a little bit cleaner and easier. And then what we want to do here is we're going to set contract back to none and return. And so what this does is it's going to take, once it sets the contract to none and returns, it's going to go through the next on data iteration, and it's going to catch it here and reassign the contract. We're investing in SPY, we're assigning the contract, we're checking to make sure it rolls over properly. Now we need to actually buy the contract. So we'll do a similar check to the one for SPY. Do if not self.portfolio, self.contract. So we're accessing the contract here. Check to see if it's invested. And if it's not, we are going to assign it a weight of 1% or 0.01. So we have the basic skeleton of our algorithm here. Hopefully it'll work. And what we also want to know is, when do we want to take advantage of the puts that become valuable in a time of crisis? There's no perfect way to do it. There's no consensus about whether you should sell them at a certain point, what in the moneyness, at the moneyness. There's no defined way to do it. There's no consensus best way. So what we're going to do is we're just going to liquidate our position in the put contracts if it increases in value to the point where it's only about 30% out of the money. And again, this is one way to do it. We're just going to do it today for the sake of our algorithm here. And then hopefully we find something that works, or we don't, and we realize that we need to refine our algorithm. Okay, so we're seeing if the price of SPY is less than 30% more than the strike price, then we want to liquidate our contract. And we're going to remove that security again. So we don't want to rebuy a contract we just bought. And it'll just help us, refilter, go back and find a new contract. That's what I mean to say. And we're going to set the contract to none. So we have our basic outline. We've got our equity here. We are getting the symbol. We're using some helper variables. We're making sure to be invested in SPY. We're making sure we have a contract. We're checking to see if we need to roll over that contract and trade it. We're making sure we're invested in the contract. And we are trying to liquidate and take advantage of the tail risk hedge. So let's see if this runs. Hopefully we get a backtest. Equity is no object, is no attribute. I forgot to specify it. Set data normalization mode. Okay, so our backtest is running here. Wait a second. Okay, there we go. And let's see. All right, yeah. So April 1st, 2008. Okay. So we're getting past the initial bugs we had. And that looks good for now. So I'm going to let that run. And in the meantime, what I'm going to do is we're going to run the strategy where we only hold the portfolio, because we want to test to see what the cost of that hedge is and also what the benefit is. So are we going to be paying too much for those puts? Is the risk management that those offer worth paying for them in good market conditions. So let's just go ahead, and what I'm going to do here is add this line return and set holdings to full investment. And what this line here does is it just tells on data to skip the rest of the algorithm. So it's just going to invest in S&P 500. So let's run that. Let's see, did that work? Yes. Looks good so far. Okay, yeah, we see the performance tanking in the market crash. All right, so while these are running, we can even take just a quick point of reference here. So January 1st, 2009 was kind of the absolute bottom of the market at the time. And so our hedge strategy here, we're looking at $660,000. And with the just S&P 500 or SPY, same point in time, we're looking at $600,000. So even over just this 1 year period, 2 year period, the hedge did do something to reduce the drawdown that we were experiencing, or that we experienced with just our portfolio. Okay, so that backtest is run. And while the other one finishes, I'm going to do one more thing. So we're going to cut that out. And then I'm going to comment out these two lines, which is just going to skip the investing in SPY. And so what this will do is it'll give us a better idea of what the options cost, just in general, just what those cost, and see what kind of drag effect they're going to have on the portfolio that uses the options as a hedge. Okay, that is running. So while these run, we'll just remember that this is one way to implement tail risk hedging. There are a lot of ways to do it. You can look at different moneyness. You can look at rolling over contracts more frequently, shorter term, longer term contracts, different weighting strategies. But again, it's just going to give us a good brief look at what a tail hedge can do, both to hurt and to benefit your portfolio. Let's see. Okay. So we'll check in on the options only. So you can see here, even just in the first few months, that they are losing money, but then when that market crashes, they gaining in value significantly. So that's not unexpected, but we want to see what the longer term trend is. And as you can see the recovery happening, the value of these options drops, and it's continuing to drop. Okay, so this backtest is almost done here. And we'll look at just a couple points of reference to kind of get an idea of what our portfolio values are at different points in time. So we're seeing here, let's take, for instance, July 1st, 2018. Our hedged portfolio is at 2.17 million. And our non-hedged, let's see, is at 2.32. So clearly the non-hedged is reaping bigger returns, and so that hedge is costing us money in the portfolio when times are good. But if we look at things like the drawdown here, so our non-hedged portfolio saw a 54% drawdown, and most of that came in the recession. And I think the coronavirus market crisis recently, the drawdown would have been about 30%. But our hedged portfolio only saw 48.3% drawdown. And it's got a slightly higher Sharpe ratio and slightly higher returns. So the way we set the exit stop loss condition, we managed to benefit from the hedge that we had, and we were able to capitalize on it to at least offset the losses that were happening during the good market conditions, because we saw that it did cost us to hold those positions, but we were able to capture some of the profit, and it did limit some of the risks. Now again, this all depends on how you want to tail risk hedge, because there are many ways to do it. This is one way. You might be able to increase returns reduce drawdowns even more, or you might wind up costing yourself even more if you use different derivatives, other moneyness options. And you can see that based on this, the puts, they do wind up costing you a lot. So we're looking at 10% negative returns essentially over 10 years. So that's not an insubstantial amount. And so it is something to consider. But that being said, I hope that we've provided you guys with an idea of how to tail risk hedge, a very brief overview of what some of the options for doing that are, and how to implement it in QuantConnect. And so we're going to leave you this week with hopefully a better understanding of tail risk hedging. And if you have any questions or suggestions, please reach out to us. You can reach us by email. You can post in the community forums. You can post on the comment section of this video. We're happy to help. We'd love to hear suggestions. And the community is really active and willing to help people as well. So until next week, happy coding.